An auto apocalypse could be on the horizon as interest rates on car loans hit the highest level in a decade. Phil LeBeau is in Chicago with the details. Hey, Phil.
Melissa, this shouldn't come as a huge surprise given what we've seen with really all interest rates in a variety of areas. Take a look at the data in terms of what's happened over the last 5 years with auto interest rates. Right now, the last month, February, it was 6.26%. Compare that with last year and compare that with 5 years ago. There has been a dramatic increase in auto loan interest rates. As a result, people are looking at annual auto sales and they're saying, is it possible that we will not see a fifth straight year with auto sales topping 17 million? By the way, most on Wall Street have forecasted the rate to come in between 16.5 and 16.8 million vehicles. And that's the reason why when you look at, let's just look at the Detroit 3 automakers. With the exception of General Motors, over the last year, these stocks really haven't done anything. And GM, by the way, it's only getting benefit because of its collaboration, or its subsidiary, I should say, with Cruise Automation. People are saying, look, we think there's something to grow on there. They're not getting much credit for the fact that they plan to improve profitability later this year. And when you look at the auto dealer stocks, they are also suffering from the perception that we're at peak auto. And therefore, people are not going to be buying as many new vehicles. They totally discount the fact that these guys make the bulk of their profits either through service or through the sale of used vehicles. Oh, and by the way, when we're talking about used vehicles, even those stocks are under pressure. CarMax, Carvana. There's no love at all right now in the auto sector. Guys, the general feeling is that you have to see these guys manage profitability during a recession. And until that happens, I'm not sure these guys are going to get much credit. Really, General Motors is only getting credit because of its subsidiary Cruise and the potential there, Melissa. Otherwise, nobody has much love for these guys.
But in terms, Phil, of why these rates are going higher, I mean, for mortgages, for instance, we haven't seen a huge rise at all. I mean, interest rates seem to be very, very contained. So is part of what's going on with auto rates that delinquencies are jumping? I mean, are there other factors involved here?
Well, there's a couple of things here. One of the big factors is that automakers and auto dealers used to offer a lot more 0% financing, let's say 2 or 3 years ago, than they offer now. Far fewer offers for 0%. So as a result, when you look at the averages, they're moving higher. That's one of the factors that's there.
Got it. Phil, thank you. Phil LeBeau joining us from Chicago here. You two are in auto stocks. Are you concerned?
My concern, no. I mean, when he said they're not getting a lot of love, that is certainly true. I mean, we've been talking about peak autos for a while, and even though autos have, I believe, peaked, but GM still is really running their business very, very profitably. Nobody seems to care. It trades at under 6 times earnings, which to me is not a peak multiple for sure, right? And it has, I don't know, 3 something maybe-ish dividend yield, maybe a little under that. No love, but I'm sticking with it. I think Mary Barr is doing an outstanding job.
I don't think you can find an auto stock anywhere other than Tesla, which trades in its own stratosphere, that's not been trading at peak auto. I mean, look at the Europeans, look at the Americans. GM's gone nothing for 5 years. So, and frankly, we've been hearing about peak auto for 2 or 3. So to the extent that people might have been starting to price that into GM for a few years, broken record, agree with Karen, 5.88 times. Freshly updated 2019 numbers are going to make $6.75 a share. North America is kicking it. China is absolutely fine. GM Financial is going to made $400 million last quarter. Europe is a mess, but they're getting out of that business.
Yeah,
and Phil just talked about how can you navigate in a downward cycle. I think GM's giving you everything you need.
Where are you in the auto trade?
So as far as autos go, I mean, as vehicles become less affordable, more people are going to opt to fix their own cars. So we like the auto parts retailers. So you look at O'Reilly, AutoZone, Advance Auto Parts. You've seen great earnings out of these companies lately. And if you look back to July of 2007 until July of 2009, the S&P was down about 38% over the course of that time frame. O'Reilly was up 4% over that same span.
The problem with the big automakers, they can't get out of their own way. And I think that has to do with the fact that this is an industry that is also being disrupted. We know that mobility is changing. People aren't buying. The buying habits of millennials are very different than they were in the past. So it's not to say you go and short GM and anything like that. They're at great valuations. It's just that what's the catalyst going forward? In terms of the interest rates going higher, we did see a slight uptick in junk yields over bonds in the December period when we had that stock market sell-off with consumer credit at all-time highs. At the margin, you're going to start to see some delinquencies. I don't think there's anything to worry about with autos. I'd be much more concerned about the fact that people don't want to buy 3 cars and have them sitting in their garage anymore.